Imagine spotting a flawless setup on USD. You enter the trade, but a minor 20-pip retracement wipes out 10% of your entire account. Technical analysis is only half the battle. A perfect entry is irrelevant if the position size is large enough for a minor fluctuation to liquidate the account. A common mistake is using fixed dollar risk, deciding to risk exactly $100 on every single trade, regardless of the available account balance. Look at this graph showing a shrinking account balance. If a losing streak drops a $5,000 account down to $3,000, that fixed $100 risk spikes to over 3%. You increase exposure during your worst performance, but applying the fixed fractional formula locks risk to 1%. The risk drops alongside your balance, flattening the curve. As your account shrinks, your position sizes organically scale down to protect you. Mathematically, it becomes incredibly difficult to ever hit absolute zero. Mastering this calculation removes the emotion from your downside. You convert an unpredictable gamble into a strictly controlled business expense. To figure out exactly what size trade keeps your risk at 1%, you need a specific formula. You multiply your account balance by your risk percentage, then divide that by your stop loss in pips multiplied by the pip value. On a whiteboard, it is elegant. In the live Forex market, hidden variables are constantly trying to break that math. The first hurdle is the unit count. When you type 1.0 into your trading platform, you aren't buying 1 unit of currency. You are buying a contract measured in lots. This diagram breaks down those volumes. A standard lot holds 100,000 units of the base currency, a mini lot holds 10,000, and a micro lot holds 1,000 units. A 10-pip move on a standard lot costs $100, but on a micro lot, it costs just $1. If your math calls for micro lots and you accidentally enter standard lots, you instantly multiply your intended risk by 100. Knowing exactly what contract size you are buying is the mandatory first step to ensuring your execution matches your risk tolerance. The second variable that breaks the equation is the pip value. A pip, the smallest price move a currency makes, does not have a universal dollar amount. Its value is dictated entirely by the quote currency, which is the second currency listed in a trading pair. This graphic shows how a US dollar account values pips. On the left, any pair ending in USD, like URUSD, has a static value of $10 per standard lot pip. But on the right, for a pair like USD-JPY, the pip value constantly fluctuates based on the yen to dollar exchange rate. Treating them as identical ruins your risk-reward ratio before the trade even opens. Then there is gold, or XAU/USD. A $1 move in the price of gold equals 100 pips of risk per standard lot. Applying standard currency lot sizing to a volatile commodity like this routinely liquidates accounts in a single daily swing. The third variable to understand is leverage, which carries a massive misconception. Many assume that a high leverage account automatically guarantees high risk. Leverage only dictates how much of your own money is locked up as collateral to open the position. It never changes the amount you lose per pip. A 0.1 lot loses the exact same amount of money whether your leverage is 1 to 30 or 1 to 500. Manually tracking fluctuating yen values and gold volatility for every single execution introduces human error into a process that requires absolute precision. The math gets even heavier if you fund your trading account with a non-USD base currency like euros or a stablecoin like USDT. If you risk 50 USDT on a British pound to Japanese yen trade, you have to convert your risk through live exchange rates to find the correct lot size. Relying on an exchange rate you memorized last week creates risk creep, slowly inflating your actual exposure over time without you noticing. You need a tool built to process these variables in milliseconds. The FXNX lot size calculator handles the heavy lifting instantly. You input your stop loss and risk percentage, and it automatically cross-references the live pip value, manages the base currency conversion, and outputs the exact lot size you need. Automating the variables removes the anxiety of the unknown. When the math is certain, your focus shifts away from the what-if and onto the execution of the strategy itself. Stop guessing your exposure. Bookmark the FXNX calculator and run your numbers through it as a mandatory pre-flight check before you ever click execute. Survival in the markets depends on managing the trades that go wrong. Using the math of longevity ensures that a single loss never has the power to end your